Hey, Sarah. So in a letter to investors that I obtained from a source, Tiger Global says it's launching a new private investment fund similar in size to its earliest vintages. Now, Tiger was part of that mega fund frenzy of 2020 and 2021 when it took positions in OpenAI and Waymo. Those two companies, they're now leading the current cycle. In fact, the letter discloses that Waymo is now delivering 450,000 rides per week. That is nearly double what Waymo last shared in April. Now, both the letter and the audio from founder Chase Coleman's call with investors, which I also obtained, point to a strategic reset, a more disciplined, restrained Tiger Global, less spray and pray approach, which marked that 2020 and 2021 years, and more targeted bets. Now, the largest positions in the last fund, as I mentioned, OpenAI and Waymo. Tiger first invested in OpenAI in 2021 at a valuation of less than $16 billion, and in Waymo that same year at $39 billion. So those are stakes that today sit at massive paper gains. Now, those investments have also helped performance rebound. Year to date, Tiger's most recent fund, according to a presentation that I viewed, is up 33%, a comeback from those declines of the last few years. But guys, amidst market concerns about an AI bubble, the letter and the audio, they also signaled some concern. The letter says the firm believes that we are in the early stages of a multi-decade AI value creation cycle, but that it's approaching that shift with humility and discipline. Now, it explicitly warns that valuations today are elevated and, quote, at times unsupported by company fundamentals. So the strategy that Coleman lays out now is simple. Prune aggressively and reinforce its biggest winners. Tiger says it has sold more than 85 companies from a previous fund, generating over $1 billion in proceeds, money that it is now recycling into follow-on investments like OpenAI and ByteDance because it sees consumer tech as a winner-take-most market. Guys, we also know this narrative. Tiger is also up against the mega caps in this cycle, and AI. The biggest checks are now coming from those trillion-dollar companies, not just venture firms. Raising a new fund now means stepping back into an arena where these competitors have just never been bigger.
Yeah, Dee, exactly. And so therefore, capital not really scarce. I would imagine there's a lot of seasoned VC funds where the biggest positions are OpenAI and Waymo or thereabouts. In other words, we aren't getting exits out of the private market as fast as we'd want necessarily to recycle the capital.
Correct. There's more reason than ever for companies to stay private for longer because capital is so flush. And, you know, like we said, it's not just these VCs or crossover firms, but it's the mega caps as well. And there's been sort of this narrative shift, Mike, for as long as I've been in San Francisco, about 10 years. It used to be sort of this really important milestone to go public and become a public company CEO. And that's just really not what you hear much anymore. A lot of the CEOs and founders that I talk to of startups say that they'd rather build in private because you don't have to sort of do that hamster wheel of quarterly earnings. And when you have so much capital in the markets, it makes it easier to do that. But I did think it was notable that Tiger, as a tech investor, says that it's getting a little bit frothy. Valuations are elevated at a time when, you know, some others are saying similar things. Like Demis over at DeepMind Google said that startups are looking a little bubbly, too.
Yeah, always harder, I guess, to do the bubble thing in the private market, but notable. Thank you, Deirdre.